little bit about Foundation for Economic Growth and Welfare, in short, the EGROW Foundation. Very young foundation. It's a think tank which has been established end of October as a Section 8 company. You must have read about it, that's why you all are here. So I'm not going to take too much of your time on that. But in brief, the focus, aim and the objective of EGROW Foundation is very simple: research-based policy recommendations. It is in this context of research-based policy recommendations that we conceived of this conference of banking and its future for our own country. Setting the tone for this conference, as you know, banking is very important for macroeconomics. And if you look at the fiscal and monetary policy, two wheels of economic policy, finance and labor are two important components. Banking provides the other wheel, which is the finance component. In any emerging country, especially in a country like India, where population is very young and raring to go, banks play a very important role in finances. Of course, in advanced countries, the stock markets take over that role to a significant extent. But in an emerging country like India, it is the banks that play a very important role. And that exactly is the role we are anticipating in our own country. The savings rate is nearly 30%, which is amongst the highest in the world, not of course as high as China, but much higher than many other countries. And banks play a role in collecting those savings and then channelizing them into productive channels which go to enhance economic growth. In recent years, especially in the last 2 years, unfortunately, the public sector banks recorded very high non-performing assets, and that became a point of discussion for a very long time. There are various ways to handle non-performing assets. You could recapitalize the banks, there could be disinvestment, there could be privatization, and the government had been thinking on various things in mergers and acquisitions to strengthen the banks. The government has taken various initiatives and thinking about it. It is in this context that Basel norms came under discussion. Basel norms, as you know, have been playing a very prominent role since 1974, and now we have had different stages of Basel norms since its inception. We had Basel I, we had Basel II, Basel 2.5 and Basel III. And in each of these Basels, emphasis was on different things. When we started in 1974, Basel I was looking at the credit risk. In Basel III, it's basically capital conservation and buffers. India has played a very, very significant role in the deliberations, and this will come through in the panel discussion today, in the deliberations of Basel norms and even implementing these Basel norms. But if you look at the Basel norms and India's standards, we have had a very strict standard, stricter than the Basel norms, which were internationally applied. And you can look at different parameters, different yardsticks, and you will see, yes, India was following a very strict Basel norm. Take any indicator, and we were on the stricter side. Basel norms, when they were conceived thinking they'll be applicable to set international standards, and therefore they were meant for internationally active banks. In India, as you can see from the statistics here, of the existing public sector banks, only 3 are internationally active. Many banks do not even have a foreign branch. If you look at the private sector banks, the story is not very different. Very few banks, commercial banks in India, are internationally active. Now, the other issue that has come up in various fora and discussions, who should be regulating the commercial banks? The first was the public sector banks and their NPAs, and just flagging two issues. There are many more, but just flagging two issues: governance issues and who should be actually regulating the commercial banks. Globally, there's lots of literature. Why should central banks not supervise the banks? There are arguments for it. And then there are arguments which say that central banks should supervise the commercial banks. Both the arguments have their own weight. If the central bank is supervising the banks, there's joint responsibility, gets better results. After the crisis, in some countries where there was a separation, they went back, especially in the case of UK. But then there are arguments which say that if the central bank supervises, it compromises on the independence of the monetary policy and the interest rates. There are arguments which say that prudential supervision can get impacted if the same job sits in the central bank. So there have been debates on this another issue of regulating and supervising the commercial banks. If you look globally, different regions and different countries follow different patterns. In advanced countries and EU, many times the central bank is supervising, but in many other cases, no. Similarly, if you look at developing countries, the situation is again varied. Sometimes the central bank, sometimes the ministry, sometimes an independent authority is regulating and supervising the commercial banks. One issue that has been in the minds of policymakers in our country is the issue of prompt corrective action. It started in the US in 1991, but many countries have not used the tool of prompt corrective action. In our country, at one point of time, 11 banks were under the prompt corrective action. And once again, because banks lubricate the growth process, provides finance, especially in an emerging country, and in a country which is young and demographically very, very young and raring to go, if there are constraints on the banking system, it impacts growth. Just a few countries did use PCA, and triggers were very different. So, when it comes to Basel norms, I showed you earlier, we were very prompt in implementing them, but there are many countries which have been a little slower or have only implemented it partially. So there are variants in the world, and this was just to give you a glimpse of the issues that are very, very important in the banking sector. So many challenges in banking, but then there's been lack of research on the banking sector. And that is why it is a couple of months ago, I had the privilege of interacting with the Vice Chairman of NITI Aayog and brought these to his notice and said, look, we need to start thinking and deliberating on the banking issues. And why so? Because anything which happens to the banking system finally reflects onto the fiscal authority, and provisions have to be made in the union budget to accommodate banks through recapitalization. Should we not start thinking in terms of research on banking sector? He listened and he said, fair enough, let's do something together. And the idea of this conference came up, and he blessed the conference by saying, we will do it jointly. So I must thank you, sir, for this great encouragement. And the fruits of that discussion is before all of you, and we are all here together to spend the day together thinking about research on the banking issues. Now, the theme of the conference is basically future of banking, and the sub-themes are evaluating critical banking situation in the country, considering national and international developments. So taking into account, and when we invited the papers, we selected those papers with the theme in mind, and papers which could bring these different issues together. Recapitalization of public sector banks, and you will see some papers, and insolvency. The future course of prompt corrective action, and as we stand today here, of the 11 public sector banks which were under PCA, 3 have been removed, and the papers going by the news reports, 3 more would maybe eased soon. But as of now, 8 are still under PCA. As a researcher, as an academic thinker, one thought comes, are there alternatives to Basel norms? And why I say that is very, very important. It just happened a few months back. I was given the responsibility, and I thank the government for that, of chairing a public sector bank, Punjab Singh Bank. On assuming the role as a chairman non-executive, the first assignment given to me was by the bank authorities, sir, we are celebrating 111 years of our existence. We came into existence in 1908, June. And that was very big surprise to me. Oh, I'm chairing a bank which has 111 years of checkered history. It has survived the world wars. It has survived the Great Depression. It has survived the partition of India. It has survived the first nationalization, and then it was nationalized in the second round in 1980. In 1947, the bank had 15 branches, and on partition, only 2 were left this side, and we had to start again, and today we have 1,500 branches, 1,200 ATMs. Don't we have something to share with the world and tell the Western world, this is how you survive? And this is Punjab Singh Bank, exactly the area where the partition took place. On digging further, I realized I'm not the only bank with 100 years such important checkered history. There are 10 more banks. Some banks, nearly 200 years, some banks with 150 years of history. How did we survive? So therefore, the thought that are there alternatives that we need to think? Can we tell the world something about our story, and maybe they can benefit from us? And finally, something that's been happening in our country, mergers and acquisitions. This is the main theme of the conference on which the deliberations are going to take place today. The conference is designed in 2 major segments. The policy segment before lunch, where we will have the policy makers from the IMF World Bank, as well as within our country. We will be honored, the Chief Economic Advisor of the country will be joining us on this panel. We have the bankers panel, where we have serving and retired MDs talking to us about banking. Post-lunch, we have the academic session. There were 36 papers presented offered in the conference. We have only selected very few, about 7 papers, and those will be presented in the post-lunch session. Technology is playing a very important role. The valedictory address is going to be given by Mr. Kumar, who's from Rabbit, and he will talk about technology in banking in India. That's the structure of the conference. So with this, I conclude my welcome address, and once again welcome all of you. Now I'm requesting Dr. Arvind Virmani, the chairman of EGROW Foundation. And when we started the EGROW Foundation, we started with the main aim, as I told you, research-based policy recommendations. He graciously agreed to be the chairman. Actually, the thought of EGROW Foundation goes back to 2009, when he and me were both together at the IMF, and we were thinking, how do we expose our students to policy-oriented and policy professionals so that they supplement their knowledge from the academic world with the profession. Dr. Arvind Virmani, as you already know, was the executive director at the International Monetary Fund from 2009 to 2012. He was the chief economic advisor, Government of India, before he went there. He has on different boards. He was also the director of EGROW, very much research oriented and very much policy oriented individual. So he is the chairman of the EGROW Foundation. I would request him to please bring along the chief guest, Dr. Rajiv Kumar, on the panel. I would now request Dr. Arvind Virmani to take over the proceedings. He will introduce our chief guest for the day, the inaugural speaker, and then we'll take on from him. Dr. Virmani.
Thank you, Charan. Thank you very much. That was an excellent introduction to the seminar conference. Let me start by welcoming our co-host, Dr. We had talked before he went for his medical stuff abroad. He had agreed to inaugurate this conference. And as some of you may know, since he came back, he's had a flurry of activity. In fact, I met him on Monday, I think it was, at the RBI. And perhaps, I don't know for sure, but I think he's been overactive. So though we'll miss him, he's unable to come today. But perhaps we have the satisfaction that if he takes it a little easier, his recovery will be faster. With that, let me just introduce my old friend and colleague, Dr. Rajiv Kumar. The interesting thing I would point out, of course, he is now the vice chair of NITI Aayog. But the interesting thing when you read his CV is, he has a very diverse background, in the sense he's worked in government, in multilateral development institutions, in private industry, in non-government think tanks. So in that sense, a very diverse and interesting history, which I'm sure serves him well as vice chairman of NITI. So just briefly, he has been, economic advisor in the Ministry of Finance. He has been principal economist at the Asian Development Bank. He's been Secretary General of FICCI. He was the founding director of Pehle India Foundation, and also, in fact, my successor at EGROW, I think, where we were both headed the institution. So we have a long history together, and it was both my pleasure and very great honor to welcome him for this conference.
Thank you, Arvind. Thank you very much for embarrassing when we were both together in the Department of Economic Affairs, both as economic advisors at that time. Thank you for this introduction, and thank you, Charan, for inviting me to this conference, which, as you said yourself, was a result of what we had thought and plotted together. And the plotted together was simply because I think all of you would share Charan's and my concern that the Indian banking sector can be doing much better and will and can be a much bigger player on the global scene than what it is today. It's not for a minute to take away from the great contributions of the banking sector that we've had. We've seen, as he said, from 2 centuries and after independence and after nationalization. But I hope all of you would agree with Dr. Charan Singh and myself that we do need more effort, we do need more research effort, we do need more thought and policy action perhaps to get this sector even moving faster and contributing more to the Indian economic growth going forward. So thanks again, and I just let me start off this by saying that the government inherited a rather dismal picture in 2014. We can say, one could say that it was also a better picture or a good picture because at least what was there on the books hidden had been brought out by July 2014, and we were staring at something like I think it's well known, at 8.5 lakh crore of non-performing assets, the result of the asset quality assessment that had been done by the RBI at that point of time. And this 8.5 lakh crore of non-performing assets, I think, rose to 10.5 lakh crore in the next 13 or 14 months. And so that was what was, that is what was straddling the banking sector. That is what was, that is what we faced, and as a result of which, as I'm sure all of you who are in the banking sector know, the credit growth in the economy, the growth of non-food banking credit began to decline in the next 3 or 4 years actually. And it's only in 2017 that growth has begun to pick up again, and the growth of credit to the industrial sector, because non-food credit goes to several sectors, but the sector had actually become negative. And this is the sort of difficult time that this government has been through, and it's actually in some sense quite remarkable to note that despite this, despite in some sense the very juice of economic growth having been turned off, because credit is that particular juice or nourishment, we've managed an average of 7% growth in real terms in the last 4 years. So I think we must therefore at the moment give a lot of credit to the government, to the finance ministry and to the central bank to have persisted with what they've done and be able to see this through, to have been able to to have been able to come out of it, the cleanup, the 2 lakh crore of capital infusion last year, the 48,000 announced this year, some of the governance reforms that you've seen happening, and I think and it's quite clear that despite all the noise that you hear in the media, etc., the RBI and the North Block, the Mint Street and the North Block, have worked together. I mean, despite all the talk about conflict of the suppression of autonomy, this, that, and the other, it's very clear that the two entities, the Reserve Bank, Central Bank, Reserve Bank, and Finance Ministry have worked together to go through these very troubling, very tough financial times without even one casualty. Because that would have been the best, that would have been the easiest thing to have done, that there were several banks which would have gone belly up, and that could have been the end of the story. Maybe somebody would argue that might well have been a better outcome, because in some sense there would have been a signaling there or there an effect there, but nonetheless that would have been hugely disruptive. And I think therefore the government, as the owner of public sector banks, has played it very hard, but found the monies to recapitalize this bank and to bring them up to where they are at the moment. So therefore, as a result of which, you've got, I think, 4 of the PCA banks now being moved out of that, and the growth of non-food credit beginning to perk up again. And so therefore, what we therefore have today is a banking sector which is beginning to tick again, and which is beginning to work, which is beginning to contribute again to economic growth, because and it has to contribute a lot more, because as we know, in India, the credit to GDP ratio remains, I think, at about 50% or something like that, which is far lower than most other economies. And I think this is where, if in broad terms, in broad macro terms, the Indian economy remains heavily deleveraged, under-leveraged. And we have therefore, in that sense, a very large potential for further growth. And one of my colleagues, Ajit, who is here, I think somewhere, talks about it, Ajit Pai, that we have got a long runway on which we can take off and we'll make use of that. And I think that's just the right thing to happen. So therefore, we've gotten over this crisis. We are now on the growth path. Wonderfully, the good news is that, in my view, the macroeconomic situation in the country is probably better than ever before. If you take a weighted average of growth and other macroeconomic factors like current account deficit and the inflation and fiscal deficit, if you put them all together and weight them in some sense, you've got a growth situation which is perhaps better than ever before. And I think this is the ground, this is the basis for us in NITI Aayog to expect that we will go beyond 7% in the coming years. I think the ground has been laid, the foundation has been laid for a significant uplift in the growth scenario as we go forward. And I will not be surprised. I think we are on the cusp of a major change in this economy because the rules of the games have changed. The rules of the game have changed to make this economy more organized, more formalized, more transparent, and more accountable. I think those are the four major things that we have achieved in the last 4.5 years. That has caused some pain. That must have caused some pain, of course. I mean, with the introduction of the GST or the launch of the demonetization or the Real Estate Rural Regulation Act or the Benami Transactions Act, etc., all that fizz that used to come in the economy through cash transactions, which is an additional 30, 40, who knows what percent, that's of course subsided. And that having subsided means that there are some people in the economy who are finding it more difficult than before to grow or to carry on with the business transactions. But I think this has been for real good, for much better for the economy. I mean, the economy today is on therefore solid foundations, without there being the fizz, which is very often, as you notice in the case of a Coke bottle or a beer bottle, can overflow and create, and by overflowing means create crisis in the economy, which is what we've had in the past. We have had this boom and bust spurts, cycles. And when we go, you get 10% growth and you get 12% inflation, or you get a current account deficit which is beyond 3%, etc. I think now for the first time in these 4 years, the solid foundation has been laid by the sheer hard work of the government, the central bank, Prime Minister's office, and a little bit by NITI Aayog to make sure that this economy can now grow at plus 7%, if not 8 or 9 in the near future, without there being overheating, without there being bust, and without there being a non-sustainable, and most importantly, with a large dose of inclusion in this growth, so that this growth will not lead to further rise in inequity and inequality, because the large number of schemes that you've seen being launched by the government, with the very big difference that these schemes for beneficiaries, for targeted beneficiaries, today are being undertaken in a manner which is where the delivery of the government is far more efficient and far more transparent and far more accountable than ever in the past. I mean, it is wonderful to report to you that we have in NITI Aayog an organization now called the Development Monitoring and Evaluation Office, which monitors on a real-time basis all the flagship schemes of the government and reports it directly to the Prime Minister, and who then sits there for hours together to review them and on the outcome basis. I'm just bringing that to your notice, ladies and gentlemen, simply because I think the same practice of transparent, formal, efficient governance must now be transferred to the banking sector. And I think a beginning has been made. A beginning has been made because this government, I think we can say with quite sheer sense, with honesty, with all our conviction, this government has put a stop to what was earlier sometimes referred to as phone banking in the country. And with that gone, I think you are entering into an era, and as a new era comes along, you get the birth pangs of a new era being born, and you can witness that in many places. This new era would be one of due diligence, proper credit risk assessment, management, and monitoring of your assets and of your advances as you go forward. And I think therefore the banking sector will now be on a different footing as we go forward. Whether it's the public sector or the private banking sector, or indeed if whether it's the non-banking financial companies or the HFCs, whatever, I think those will be the all those sectors would have to live with the fact that now on they have to be responsible and they have to be accountable for the performance that they do. The government has adopted arm's length approach to the management with the appointment of people like Dr. Charan Singh as the non-executive chair of leading banks. I wish and I will push for even more banking governance reforms in the banking sector in the light of the EGROW committee report, which I think had done a splendid job, and which is, I think, where some of these reforms and some of those measures are still yet to be. And I notice Subbu there, who's been a member of that NITI committee, is now the chief economic advisor, of course. Welcome. I think that is what is required to be done. And what is required to be done, and I've been on the bank of the State Bank of India for a good long 6 years, so I've seen banking governance at very close quarters. It becomes an entity, basically, without much functions. So that's one of the issues. I don't know how far in detail to go. By the way, I must confess to you that this has been a sector. I first got onto a board of a bank which is not anymore there, which is called the Shipping Credit Corporation, SCICI. It used to be in long ago, and when I was in the DA as economic advisor in the 92 or 3, I have a deep sense of involvement with this sector. And the deep sense of involvement, not just with the banking sector, but with the Indian capital financial sector as a whole. And I think we still need, and I hope all of you would agree, that we need to go a long way in seeing the full development of this financial sector as we go forward. So I mentioned to you already of the governance issues, and I hope you will focus on it. The second issue, I think, again, which Charan had mentioned, is the size and the scale of our banks. I think the largest bank that we have in the country is still the 60th largest in the world. And this is a bank which goes back, its history is the Imperial Bank, etc., right? I mean, and that doesn't give you the clout in the global financial markets to be able to lower price your capital in some sense. The advantages of scale are just not there. And I wish and I hope that whatever we need to do in the government to improve the scale, to improve the size of our banks, whether it's through further mergers or it's through a greater capital infusion, I'm not sure, but I think we do need in this country a few large banks that can compete globally and be able to attract investors' funds into the economy as we go forward. One of the things that I have always noticed, again, from starting with the public sector and private sector banks to NBFCs and HFCs and the urban cooperatives and the rural cooperatives, and then the state cooperatives, and then you've got the other. Our financial banking sector is hugely fragmented. I mean, and several studies have gone into this, as to how, and as a result of which, gentlemen, you'll agree, maybe that's one of the factors, and not maybe even the only one. The cost of capital in this country remains inordinately high. It's just not feasible for our companies in this country to compete with others from the other countries. When you face a real cost of capital which is excess of 8, 9, 10%, and that's the real cost of capital, very often for the smaller borrower, even a BBB borrower, will have to borrow at about 13, 14%, and with the rate of inflation now at 4, the cost of capital is incredible. And then in the market, you get borrowings at 2% a month. And then you have the SHGs lending being allowed to lend, I think at 18 or 20% or something like that, at 8% margin and borrow at 12%. How can we compete? How can we compete globally and effectively if that's the cost of capital which remains? How do we bring this down? And that's the issue that I think we must concern all of us. It isn't that we don't save enough. India saves up to 35%, 32%, 33% of its GDP. Maybe that's a smaller fraction if you take into account all the informal sector GDP. Maybe that's the reason. But the cost of capital in this country must be brought down if we have to achieve the aspirations that our young people have of their employment and growth as we go forward. So that's the second issue I'd like to pose to you. The third one, the fourth actually, so therefore the governance, scale is related to to cost, and therefore this is why I brought it up. The other issue that I wanted to raise is and I think Charan has raised it already. I don't see, and I've written it in public and said it in public before, as to why our banking sector should be subjected to higher than Basel capital adequacy norms. I mean, this was decided in 2013, I think. It was, my view, I have not yet seen a complete explanation of this. The only explanation that I saw coming from the Governor Central Bank at that time was that the Indian conditions mean higher risk premium, and therefore you need to have a capital, tier 1 capital which is 1% higher than the Basel Committee recommendation, and as a result of which all of this, so you got a 14% cap, and then bankers, being conservative by nature, which I hope they should be, say that, well, if the central bank is saying 13%, let's add on a couple of percentage more to that. As a result of which, your leveraging is just becomes, so for every rupee that you get, and for all the, this 48,000 that you got, you should have, at a leverage of 6, you should have, or 9, you should have, you should have been able to provide that much credit, but you will be able to provide much less because of all these. Now, if we agree, and I've said publicly that I don't, if we agree that currently the higher capital norms are required, higher than Basel, then do we have a glide path to come to that, to come to the normal one? That's the question to ask. What are the drivers, what are the reasons, what are the factors, which make our, which require us to have capital adequacy norms which are higher? Is it that our banks do not have proper risk management capabilities, risk assessment models? Are these models there but not being really worked, and you only, you lend because of intuition? Whatever those drivers are, whatever those factors are, I think we need to identify them and then spell for us a timeline that, look, by this time you will get to Basel norms or perhaps lower, as China has got, because 70% of your banking sector is publicly owned, 100% of your banking sector is implicitly sovereign guaranteed, as you saw in 2008-9 when ICICI had a small dent, and then the government rushed into their help. So that's the fourth issue. The last two issues, let me just point out, is one about long-term finance. The 5 into 5 rule, or the 25, it doesn't, commercial banks are not there to finance infrastructure. They have not been traditionally, and I don't think they should be. Theirs are on the liability side is short-term liability most of the time. So their assets, so there is got to be an asset liability match, which is not there at the moment. So how should the long-term assets be financed? That's the question that we have in front of us. The earlier answer to that was development banks, IDBI, etc., which we have seen their better days, and we have consciously policy decided not to have them any longer. There is a conversation very often I hear that we should bring them back because we need it, and in disguise of sometimes sectoral banks, that you should have sector-specific banks, sometimes in disguise of others. But is that the way forward? I'm not sure. I don't know the answer. Or is the way forward for the long talk, discussed development of the corporate bond market, which it just refuses to develop. And since the time of Mr. Desai onwards, the first report, Patil, I think that's so what is the way forward for this? I think this is a real issue in our economy. Or is it that we will have these debt funds, that we have? And if those are the debt funds, then how will they be financed, and who will manage them? How will they be supervised? So that's and last, because I think I've gone on for far long enough, but I thought I'll take this opportunity of such a erudite audience to speak out my thoughts. The last is something which we normally don't want to talk about, is that what should be the composition of our equity? Have we reached the limits of foreign equity participation in our banking sector, or is there more room available? The limits that we placed on it at the moment, is that it? or can we go higher? If go higher, then what is the way, what is the methodology for doing so? I think that's the other issue, both for our banking plus also our debt markets, and the bond markets, as to how how do we integrate the Indian financial sector more fully into the global financial sector while not losing regulatory control. I think that's which is the key. So that's where I think we need to do. Just one last one, which is that I have talked about the fragmentation. I have talked about the governance and others. I think the last one should be on that whether the central bank should continue not only to have a monetary policy role, but also the banking supervisory role, and also the role of managing government's debt. I think there has been a conversation very often. I think since I was in the Ministry of Finance in 1991-5, that there needs to be a national debt office. And it was announced, I think, at one stage in a budget speech, but hasn't happened so far. I think it was in the 2014 July budget speech that the finance minister had announced it. How do we manage? How do we segregate different aspects of Reserve Bank responsibilities? And and what is the better way of? You raised it to a little bit to extent, and in this context, you will accept that the government has been very courageous to give the Reserve Bank now a statutory authority, statutory responsibility for the inflation targeting. And that's the decision that's been taken. So therefore, who then looks after growth and employment and the debt and the leveraging, etc. in the country? I think those are the issues that that we need to discuss. I congratulate EGROW Foundation for organizing it at such a wonderful time. This is the time for preparation for the longer term, and I hope that we will receive from friends like Arvind and Charan and all of us who are here some wonderful, some very practical suggestions on how to further reform the banking sector. Because as I said to begin with, I think, and you will agree, I hope, that the banking sector does need more reforms, does need more redoing, and not just the banking sector, but the financial sector as a whole. Thank you very much.
Thank you, Dr. Kumar. I think he's given a masterful talk on the policy aspects, which we will be discussing subsequently. But I can't resist three comments. Reviewing the Modi government's performance, and I have a chapter in that which is on our EGROW website. So those who want to get another view of the macro performance of the thing, you might want to look at that. Second, on the equity composition, I would add the issue of 70% of the banking system being owned by the government. It's really unprecedented. It doesn't happen anywhere in the world, so we should discuss that also. And just a third comment, again on a personal note, if I may end before you come up, is that I actually chaired a committee on the Independent Debt Office in the 2000s, in the late 2000s. And I think it's now long enough time for me to say that the RBI was so upset by the report that probably the first time in history the committee was dissolved before it could give its report. I mean, it's unprecedented. I mean, you'll be, these are the kind of things which used to happen. Never, as far as I know, never since or never before has a committee been dissolved the week before it was going to give its report. And the interesting thing is there were three RBI representatives on it. I was the chair. And all three had agreed to the report. You know, it was not a wild theoretical report. It was a good compromise of practicalities. But the sad thing is that we were not even allowed to present the report. So, as I said, it's long ago, so I can tell you what I did was, I then immediately put that report on file, that at least there'll be a record of it. And anyway, all kinds of odd things happen. But let me invite, I think we are make some final presentation. Why don't you come up and just a little memento before you leave? Yeah.
sure. So, may I request Dr. Charan Singh to present the memento to Dr. Rajiv Kumar.
Great, thanks a lot. Thank you. Yeah, so I think we are running a little behind schedule,
Yeah.
so why don't you start
Yeah. So, friends, we are going to start a policy panel. May I request Dr. K.V. Subramanian, Chief Economic Advisor, to come on the stage. Dr. Andreas Boer, Senior Resident Representative for India, Nepal, Bhutan in IMF.